Hello, everyone, and welcome to a panel discussion about why should investor care about how ESG score works. Today, I'm joined by two of my guests, Alex and Branjal. So, Alex, would you like to share about what you do and who you are?
Thanks, Vikram. Yeah, my name is Alex Hetherington. I am based in Cape Town, South Africa. I have been working in the ESG space for the last 25 years. Initially from a media and communications perspective, and then after that from a strategy development perspective, working with listed clients, corporate clients, helping them develop their ESG strategies over time. I also co-founded and launched a carbon management and climate change company called Carbon Calculated, and over time, the ESG space, Vikram, has matured and developed. And one of the key areas that I think has become absolutely critical in this whole play is that of the investor community. So I've taken a bit of a deep dive in that, done some studies around ESG finance and ESG investing, trying to understand what are the critical issues that investors, the holders of capital, need to be thinking about from an ESG perspective in terms of, one, the impact on the value of their investments, but two, also how they as investors can drive good environmental, social, and governance performance within companies. So my work has taken me pretty much all over the world, which has been quite fantastic. And it's been a fascinating journey to be on. So thank you. And thank you for inviting me to this panel.
Thank you. It's a pleasure to have you too as well. Pranjal, would you like to share about who you are and what you do?
Sure. Thank you, Vikram. Thank you for having me here. So my name is Pranjal Mathur. I am currently an ESG and sustainable finance specialist. I have been in this space for the last 2 to 3 years. And at the moment, my specialty is in sustainable debt in particular. So I'm working with a firm called 8%. We look at second party opinion provision with a centralized theme of greenwashing risk. So that's something that's very personal to me. Prior to this, I have a background as a chemical engineer. That's fundamentally what I did as a bachelor. And then after that, I focused on environmental technology and sort of come out from sort of the more fundamentally rigorous route of becoming an engineer and learning the technical stuff and then jumping into finance. So for me, it's always been about understanding the data, being very granular about it. And that's where my interest in greenwashing risk in particular comes on an investor side. If you look at the sustainability market right now, we have green bond issuance hitting $2 trillion at the moment, but if you look at the net carbon emission reduction associated with it, it's actually not even a net reduction. It's actually a net increase in carbon emissions, despite the volume increasing in bond issuance. So I think it's a very important topic at the moment for investors to look at how they are treating ESG, and if they're looking at ratings in particular, are ratings a good proxy when they're managing their portfolios, when they're tilting their funds? It's a very important conversation to have, and I'm happy to have that here today.
Great. Two very different guests here. Both will come a different dynamics and perspective. So let's jump into my first topic here is this one. I think let's go with Alex first. So what are the primarily first, let's talk about positive. What is the investment benefit of using an ESG score?
Well, it's a good question because there's a problem that's an inherent problem, I think, Vikram, in terms of the fact that you get different ESG scores depending on who the ESG rating provider is. So from an investment perspective, number one, you've got to understand that there is this discrepancy between the two, so you cannot rely on consistency. But what that does do, and I think this is the positive, is that it forces investors to actually look what sits behind these ESG ratings. What is the information? What is the data that is being collected on? How is that being ranked and evaluated? Because there has to be difference between these two in order to get such different ratings from the different providers. So I think what it forces investors to do is to interrogate the rankings or the ratings, to understand what sits behind them, and to understand how they built those rankings up from the information or the data that they have. With that interrogation, you can then start to evaluate the company more thoroughly from a perspective of understanding the different indicators that have been covered. So that's the positive, but the positive, unfortunately, comes out of a negative.
Thanks for sharing that. Pranjal, what's your thought on that?
Yeah, I completely agree with everything Alex just said. And maybe what I could add on to it is when we're looking at ESG rating methodologies, there's such a huge diversity associated with it. So when we're looking at, for example, the difference between target setting versus actual reductions in scope 1, 2, 3 emissions, the amount of weighting you give to each of those sort of different material factors affects the final ESG rating. And that's sort of a very generalized broad split, but I think that's one way of looking at how ESG ratings sometimes work. And if you're looking at firms that have high ESG ratings, does that necessarily mean that they have actual emission reduction in present or at least in the near future? Not necessarily. They might have very ambitious targets, but then those ambitious targets need to be backed up with credible science, and that's where things like SPDI come in, obviously. But what I also find very interesting is that with the data problem, there's often a lot of conversation on how to manage data, how to get data, how to sort of place data in the right place. And I think what ends up happening at sort of a bottom-up approach is when you have industrial data on carbon emissions, let's say from a steel manufacturing plant or from a cement plant, that data is not used enough in these sort of methodologies sometimes. And it's important to make those connections. And I'm not saying whose fault it is or that it's someone who should be taking the liability for it, but I think what's needed definitely is to connect those bridges, and that's where artificial intelligence or machine learning operations are going to play a huge role.
Right. Thanks for bringing that up. So my second question I will ask you first is, does the ESG score helps assessing the company's overall mission in general?
So I guess it's probably going to be a fairly difficult question to answer based on where you're looking at the sector, the geography. But I think so. Barring, let's say, the wastewater sector, what I found is that ESG scores tend to tilt towards, or let me rephrase that, tend to be sort of inversely proportional to the actual carbon emissions. So let's say if you look at this publication by a professor at the University of Maastricht, and what he did was he actually developed a software, went across a variety of ESG methodologies across sectors, and what he found was that if you are looking at ESG scores and firms that have higher ESG scores tend to actually have lower emission reduction at the time of the score being given. But does that mean that they're not going to reduce emissions in the future? It's hard to say. So I think at the end of the day, an ESG score is a proxy for an investor, and an investor needs to bear in mind that an ESG score can't be the only decision-making apparatus that you keep in your arsenal. You have to look at it from a more holistic perspective. You have to do your own due diligence beyond a score, because a score is one person's opinion or one firm's opinion. So I think it's very important to have that well-rounded approach. But to answer your question, Vikram, I guess a score can be a good reflection, but it's still got sort of rough edges around it.
Got it. And Alex, what do you think? Does that help to assess the ESG score helps to assess the company's overall mission?
Yeah, I think, okay, so I'm picking up on what Pranjal said, and again, it's in full agreement with that also. I think if we make the assumption that a good ESG score is a proxy for a company that is well managed from an ESG perspective, and is performing well, so that there's actually a nuance and difference between those two. But if we take that assumption, and going to your question, Vikram, does it talk to the mission of the company, the overall mission of the company? I've always been of the opinion that a company that manages its ESG performance well is generally a well-managed company overall. It talks to the leadership of the company. It talks to the competency of the company. It talks to their data capturing and data analytics, not just from a financial perspective, but across its entire operations. Now, you look at environmental performance. So much of that ultimately does talk to the financial bottom line, right? So if you're wanting to reduce your carbon emissions, you're effectively going to focus most of your activity on reducing your energy consumption, various energy consumptions. Now, particularly in a high inflationary environment that we have at the moment, and I'm thinking particularly of Europe from an energy perspective. If you're reducing your energy consumption, you're reducing your energy costs. You're cutting your bottom line. You're benefiting your bottom line, your financial bottom line. So there's a business case behind just about all ESG factors or indicators, even on the social side, very particularly on the governance side. So does it talk to the mission of a business? Absolutely, 100%. Is the ESG rating accurate? That's a different question. But as I said at the beginning, taking the assumption that it is, then yes, talks to the mission.
Got it. So my next question is to you, Alex. So is ESG score gaining more important, or even I think the better question will be, is it equally important as the P&L or the balance sheet of a company?
Okay, I think it's got. I'm generalizing here, of course, but and also I'm talking to the geographies that I'm most familiar with, but it's got some way to go, both from a company level of perception of importance and from an investor perception of importance, but it is gaining traction. And I mean, if I think about the companies that I work with at the moment, the reference to ESG ratings, or the reference to moving beyond just simple sustainability compliance into more strategic thinking, being demanded and requested from the investor community, is starting to come into play. Like maybe 25 years that I've been working in this space, the increased interaction that myself as an ESG practitioner is now having with the C-suites, the executives in companies, and even into the boards of companies, is much more than we had in the past. So yes, it's gaining importance. It's not as important as the financials to most people and most investors, and that perhaps is understandable. But I go back to my point. Think about ESG from a financial perspective, and you can actually start to join the dots very clearly.
Got it. Thanks for sharing that. Pranjal, what's your thought on it?
I guess what I'd add on to it is as well is that when we look at ESG issues, let's say you look at the E with the more of a magnifying lens, and we look at carbon footprinting. Carbon footprinting, we've always had a very profit and loss type approach to it to begin with, and I think because of that, it's always been very easy for accountants to see that sort of link between carbon footprint and let's say the amount of money you're investing or the cost of borrowing money and things like that. So what ends up happening as a result of that is that if you're accounting for your ESG performance through a rating, or if you are maybe even not looking at a rating, but you're an investor who's interested in an impact fund, who's managing a portfolio who's tilted more towards environmentally friendly performances, introducing those positive impacts through either the double materiality type framework that the EU is now talking about a lot more as well, is a lot more easy, because it's already something that your firm is doing at a macro level as well. So I think because of that, in my mind, it's never been an issue about ESG actually gaining more importance over a balance sheet. I think the ESG score is just a part of the balance sheet, or is a part of the business operation. And the way technology in the early 2000s fundamentally sort of changed the way we operate business, I think the environmental issues are now becoming that next wave of material issues that businesses consider.
Great.
Vikram, can I just come in here with a thought on this? I think what's also an interesting development now is the publishing of TCFD reports, the Task Force on Climate-related Financial Disclosure. I mean, it's early days, and when you look at most TCFD publications to date, they are really being driven by scenario analysis, risk and opportunity analysis, assessment for climate change. But what TCFD's ultimate purpose is that companies will start to financially quantify these risks and opportunities and report on them under different climate scenarios, of course. It's complex. It's going to be complex. It's going to require a lot of actuarial and economic thought behind it. But I do think that this is a really critical step, because actually at the end of the day, we've got to be pricing ecosystem services one way or another. Typically, they're underpriced in most economies, and I think that's a quantum step forward.
Great, thanks, Alex, for bringing this up and jumping into the conversation. So, Pranjal, I will ask you this next question, which is so now this is pretty much like a like, does ESG limit in the potential of actual financial return on investment?
Yeah, so I think traditionally there's always been this investor purview that if you look at the S&G in particular sometimes, and you're looking at financing those kinds of projects, or you're trying to finance those kinds of internalized mechanisms in a corporate structure, you're going to see lower returns. But I think one of the best indicators for that not being the case is in the bond market. If you look at green premiums that have emerged prior to COVID versus after COVID, what difference you see is that it's become cheaper to borrow capital when it is labeled as green, or when it's labeled at least as sustainability linked or something like that. So I don't see the evidence particularly where someone can argue that it limits your potential. I think there's obviously the microscopic argument that in an energy transition, the levelized cost of electricity, let's say for renewables versus the traditional fossil fuel and natural gas, is slightly different. And I think you might see a slight dip in your returns maybe in the initial part of your project, but then I don't see that being a long-term systemic issue. In fact, since the word that gets thrown around a lot, circular economy and things like that, we're trying to move towards that genuine transition. And I think it's an investor opportunity really to invest into renewables. So I haven't been presented with any evidence to that, but I'm always curious to see if there is.
If let's say if Alex has a different thought with his 25 years of experience here.
Well, yeah, no, I think the jury is out on this one, Vikram, to be quite honest. If you look at the academic research that has been done over it, even in the last 10 years, you would tend to see a bias towards there actually being financial benefit from ESG performance and ESG analysis from an investor perspective. But there's also seems to be a certain amount of counter to those claims. So perhaps the jury is out. Yes, there is going to be a cost associated with things like compliance and additional compliance, both from a company and an investor perspective. But the point made earlier around cost of capital and particularly in the debt market, absolutely, I think we're going to see more and more of those green and other ESG instruments coming to the market, and I think it will start to play in a beneficial way towards the financials lining up with the ESG.
Sure. So my next question is Alex here, and when it comes from an investor's point of view, is there any lack of standardization because of these different ratings out there?
Yes, I would imagine. I think there is, and I think it's difficult for investors to be able to really comprehend the differences that are in play. you got to think about the average investor, Vikram. It is up until these days is unlikely to have been trained in any way in ESG and the value of ESG. An investor is trained in understanding financial statements, which typically are backward looking and for a period in time, 1 year. For an investor to start to understand ESG, which actually a lot of ESG is forward looking, looking at risks and opportunities coming down the line. It's very difficult. And so if you're getting different ESG ratings from different agencies and you don't understand why, and you don't have the skill set to understand why, it is going to be confusing for investors. And I think that's a fundamental problem but then obviously a challenge to bring right. But at the moment, it's a problem within the investing industry.
So what are currently some of the investors are doing to get around this challenge and still take the opportunity which is presented to us?
Well, I mean, first of all, it's the mandate on which the investor is operating. What is his or her investment mandate? Does it carry an ESG perspective to it? If so, what is that? And how is it weighted within their portfolios or other actions? And then it's the investors have to learn this stuff, have to learn the language, have to learn the indicators, have to learn what they mean. Going back to Pranjal's point about a reduction in greenhouse gas emissions, that's fine, but is it in line with the science? And so you need to understand things like science-based targets, etc. And this is absolutely critical. And if investors don't know that, then they need to bring on the resources and the skills to help them understand that. And then ultimately, the real skill for an investor is going to be able to match that ESG differential between companies with a price differential, and take a viewpoint on whether the market is correctly pricing or mispricing it. Stocks because of the ESG analysis that they've done as investors.
Sure. So moving on to Pranjal, what are the effects of lack of standardization from an investor's point of view?
So I think if we look back to 2008, what we saw was that regulatory sort of oversight was always needed, but it was sort of even systematically removed in ways that it shouldn't have been. And when we look at the ESG market right now, the ESG market has market level standardization. So the ICMA is trying to define what a green bond should look like, and now we have the EU spearheading what's called the EU taxonomy, and they have come up with a very illustrious sort of dictionary for what green will look like, and they say they'll work on social as the definition as well. For about 35 working groups, if I'm not mistaken, have been formed as taxonomy related working groups as a result of that. So I think what investors are going to start seeing is that there's going to be a lot more focus on labels rather than disclosure. So here in the UK, the FCA has actually issued a public discussion paper on how to create a green label for any product that is being sold as environmentally friendly in the UK financial system. And I think that, along with the fact that we have a lot of taxonomies, is going to help investors. So moving away from sort of these independent standards that are being set by market groups, we're now going to head towards having more of a unitary standard that can be adopted by multiple players. So I think hopefully that will help. But I think at the moment, for the next maybe foreseeable 2 to 3 years, it's still going to be a little bit of a classic information asymmetry as microeconomic students might study, which is it's just going to lead to a lot of negative externalities across the board. Like, for example, there was a leak that came out from HSBC today where they had effectively funded a sustainability-linked bond for a fossil fuel project with a 1% penalty, so 100 basis point penalty, which they was sort of their marketing tool as saying that we're being very penal on ourselves, but they weren't even funding anything sustainable to begin with. So I think because of the lack of standardization, those kind of things have happened. Now, hopefully, we're heading into new territory where we've identified those mistakes and those things won't happen as much.
Right. Pranjal, my next question, I think we have already discussed this, but if there is anything left on it, what would be the impact or effect of ESG on an investor's portfolio overall?
So I think if we look at investor portfolios, if we look at the trends from the last 25 to 30 years, they have shifted more towards renewable energy investment, even without any kind of regulatory push on them. If we look at ESG in particular, for example, diversity is an important part of S. We've talked a lot about the E, but let's talk about diversity as well. So diversity has been something that has credibly gained a lot of investment. A study by MIT recently showed that diversity related investments, such as having more safe workplace habits and having more inclusive HR practices, have garnered a lot more investment without any regulatory oversight. So I think, as far as investor portfolios are concerned, ESG has already sort of come in on its own in a very clandestine way. Now, what we're seeing is a more open acknowledgement of it, and we're seeing certain benchmarks being set out that need to be complied with. So I think for an investor portfolio, in terms of gains, as we've discussed, I don't see it being an impediment. I think it's one of the biggest opportunities. We're going to have a massive dip in fossil fuel usage, so there's a huge potential to invest in emerging markets in particular. So overall, I think an investor portfolio is bound to be benefited by the inclusion of ESG factors. I think what's also going to end up happening is that the term ESG itself might also go through a certain rundown on editions on what exactly we mean by ESG. Sometimes, like the Economist had taken a very bold stance on it just a few months back, but I think those things are good, and I think that they'll guide investors to be even more cognizant of what needs to be done.
Great. Alex, the same questions for you. What do you think the impact or the effect of ESG on an overall investor portfolio?
Well, Vikram, I mean, I think if you strip out philanthropy and you strip out most of impact funding and you look at responsible investment or ESG or sustainability investments, you've got to remember that at the end of the day, the portfolio manager has to generate a return on investment. It has, there's performance that has to be driven. The question is, can ESG help him or her do that? Right now, it's not by just investing in a company with a high ESG score. It goes back to what I think I was trying to allude to a little earlier, which is, does ESG actually indicate some kind of mispricing in the market? And that's absolutely critical. So, give you an example, is a heavy emitting industry operating in a jurisdiction that might be incurring a carbon tax further down the line? Well, is the market correctly pricing that? That's a very basic kind of analysis. But if you have an acutely aware ESG analyst working on your portfolio, you might be able to identify mispricing, and then that allows you to actually generate, alpha in your portfolio. So at the end of the day, it should be there, and it should provide benefits, assuming you know what you're looking for.
Got it. So this is my last question for both of you. So Alex, I will ask you this one. How much does it cost to be socially responsible investor?
I think we're wrapping up in that question. I think we're wrapping up just about everything we've been speaking about here, Vikram. If you are prepared to make the investment in the analysis and the skills required for proper analysis, you should get a return on that investment. So, in other words, there shouldn't be a net cost. There should be a net benefit. But again, it's all going to come down to how well you understand the ESG space.
Thank you, Alex. Pranjal, the same question to you. How much does it cost to be a socially responsible investor?
So I remember a couple of years ago when I was sort of working on a project where we were trying to compare behaviors in corporate responsibility. What we found was the paper in 1996. I forget who it was by, but a paper that said that, yep, the cost of investing into socially responsible ventures as a as a firm is far more than it is for any other type of external venture, and based on this behavioral pattern, most people don't want to do it. There was a very similar study then done after that in 2014, which gave the exact opposite results. And I think what that really just shows is that the cost of social responsibility has changed, obviously, in the market, because we've become more cognizant to the impacts of climate change and what they actually do, not just on an environmental front, but also socially to more vulnerable communities around the world. So I think the cost of socially responsible investment to an investor today who's trying to manage a portfolio and still get good returns for their stakeholders is as much as any other traditional investment. Investing into renewable energy, investing into climate adaptation, for example, is a very lucrative investment because we're seeing an emergence of money that needs to flow to emerging markets. We're looking at 70 trillion dollars of capital by 2030 that's going to go to climate mitigation into emerging markets. And I think all of that sort of combined together shows that it's a clearly good place to invest. I don't view it as a negative externality in investor, and I hope investors don't view it that way too.
Thank you, Alex and Pranjal. Any last thoughts before we wrap this up?
Yeah, I'd just like to come in on Vikram on that last point of Pranjal's there is if ecosystem services, clean air, clean water, availability of water, availability of waste sites, etc., and I'm also including in that social side, social license to operate, good relationships with surrounding communities, etc. If those start to get properly priced at their true value, then it will make the ESG investing argument even stronger, and the cost even minimal in comparison. So I think there's a tremendous need to start to really price these goods and services to their true value.
Thank you, Alex, for sharing that. Yes, Pranjal.
Yeah, I'd just like to say as well that when we look at investing, it's always traditionally been this field that is trying to move capital in a very efficient way towards gaining stakeholder value, right? And I think stakeholder value is something that is met even more through socially responsible investing. And I think ESG is and sort of an aperture or a lens to doing it. And I hope investors can find their usability or their use case on how ESG can benefit them, because I believe it's got benefit across the table, across sectors. And I completely agree that the pricing it is incredibly important. And I think the moment standardized markets get more standardized, it's going to become easier to price them, and hopefully it's going to become easier to get capital deployed as well.
Thank you very much. Thank you both, Alex and Pranjal, for joining me today for this panel discussion. It was really great to have you both.
Thank you.
Your pleasure. Thank you, Vikram.
All right. Bye-bye, everyone. Thank you for listening.